For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Welcome to the show. Oh, this is going to be fun. Thanks for joining us, everybody. A bunch of new listeners, I found out. I think I said at the end of the last show, Professor Plum, that I like to look at the count, the new subscribers.
You did say that.
When you hit a milestone, I won't say because I don't know whether it's high
10.
or not. But yeah, we hit double digits. No, it's more than that. But I'm thinking, wow, look at that. Here we go again.
Let's bump it up.
And we are approaching our 200th episode, as I've been saying for a while. But we're in the 190s.
Right, but it's still a few off.
Well, it is a few off, but it's not too far off. I mean, the fact that we're this close.
There are some people that say most of our episodes are a little off.
Not us. Well, today, this is a topic that needs some discussion, may I just say? And I don't like to be disparaging toward people who don't quite understand a very important part of their financial lives, which is Social Security. And I'm not being disparaging because it can be a kind of a complicated thing to understand. The question that we're going to talk about today, the question we're going to be answering, or at least discussing, let's say, is at what age should you take your Social Security benefits? Now, that covers a really wide range, Professor Plum.
It does.
It covers a very wide range, and so we're not going to be able to say everybody should take it at this age. Okay.
Well, like anything else in financial planning, there's a range of options.
Yeah.
And the answer depends on your reaction, your answers, your specific situation.
Right. Now, before we get into that particular part of it, though, I had somebody, I think I may have said this on the air. I don't remember, but if I did, I'll repeat myself. Somebody who asked me, they said, you know what I heard? I heard if you were born after 1960, you cannot take your Social Security benefits until you're age 67. And
there's a lot of misunderstanding about Social Security.
Yeah, and I said, well, that's not quite true. And she says, oh, yes, it is. And then we came to an understanding, as I explained. So, Professor, to start off, I think most of our listeners know this, but let's just take 30 seconds and let's give everybody the rundown.
Well, to her credit, she did understand, at least almost, that the full retirement age has been increasing over the past several years. And so the full retirement age for somebody who was born in 1960 or later, not after 1960 and later, their full retirement age is 67. So she got that part right. The 67 was correct. But that's not necessarily when you can take it. No matter what your full retirement age is or was, you can start, if you're not working, you can start receiving a Social Security benefit as early as age 62. Now, it's a reduced benefit because you're taking it early.
Mm-hmm. Yeah.
Or you can postpone up until age 70. Now, in reality, you can postpone it longer than 70, but there's no benefit for waiting. It is increased, just like it's reduced if you take it before your full retirement age. It's also increased if you delay taking it past your full retirement age, but only until age 70.
Then stops.
And that's regardless of what your full retirement age is, you can take it as early as 62 or as late as age 70. It's just a matter of how much is it going to be reduced or how much is it going to be increased. And the reduction or the increase is done on a monthly basis. They're not asking, it's 8% a year of an increase going forward if you wait from your full retirement age out to age 70. But you don't have to wait the full year to get that 8%. It's 2/3% per month.
So for every month that you wait beyond your 62nd birthday, let's say, the month
it starts going up.
It starts to go up by, what is it again?
Well, from 62 to... Okay, that one, it's a funky one because there's different numbers.
I know.
So it depends on, that one is more, but going from your full retirement age past your full retirement age, it's 2/3% per month.
Yeah. Okay. So
prior to that, it's a different discount. The first 36 months are, I can't remember the number, 5/9%. And then before that, it's 5/12%, and then more than that, it's 5/12% per month. It's like, it's a pain, but just know that it's reduced if you take it before your full retirement age and they count the number of months before your full retirement age, and it's increased after your full retirement age.
Yeah.
Anywhere from 62 to age 70.
Right.
Now, I did mention one thing. that is early part of it is assuming you're not working or you're not actually earning a wage.
Well, or you can earn up to a certain
right.
amount.
You can earn up to roughly $23,000 a year and still get your Social Security benefit. But then once you move, and that's for any year that you don't turn full retirement age.
Yeah.
Once you get into the year you turn full retirement age, the number goes up dramatically how much you can earn. Once you hit your full retirement age, you can make $1 billion a year if you can get that job
benefit.
and still get your Social Security benefit.
Yeah. So, okay. But yes, we're making certain assumptions here. All right. So now that we've established what those parameters are between age 62 and age 70, it's nice to know that you can take it early if you need to. It's nice to know if you can take it later. But, of course, this presents a problem for some people because now you're faced with a choice. You've got a lot of options, and it becomes a problem for some people who will say, I don't know. I mean, gosh, I would love to take it at age 62 because, gosh, I got some money coming in.
Well, let's go back to the reason why is it reduced if you take it before 62 or increased after your full retirement age. And the reason is they expect to pay you out the same amount of money over your life expectancy, basically. So if you take it early, they're going to give you less per month, but cumulatively over your lifetime, you'll get the same cumulative amount as you would have if you started later and lived to the normal life expectancy, where you got more per month, but a shorter period of time.
Yes. Fewer checks, but a higher amount.
And so the question is, are you normal? Is your life expectancy the normal actuarial life expectancy as they've calculated it into the formula?
Yeah. So what they generally tell you is that if you expect to live a long time, it's probably better to wait as long as possible to take your Social Security benefits.
Up to age 70, potentially.
Yeah, if you can. And then if you don't expect to live a long time, you may want to take it early. Now, that's a decent rule of thumb, Professor Plum, when you're trying to figure out when to take your benefits. But I got to tell you,
you're only looking at you as an individual, non-married, single person. That's the starting point for determining what's going on. When do you expect to die? What do you want to bet? This is a bet. You're betting cold hard cash, in the form of a Social Security benefit that I may or may not receive early, or I'm betting cash, and I have to live a certain amount of time to make that bet, to make delaying taking it work in my favor, or I have to die before a certain period of time to make, from a purely financial standpoint, taking it early benefit me and my heirs for that matter.
Yeah, and this is where the understandable confusion can come in. So when we ask that question, when should you take your Social Security benefits, let's talk about a few things that you need to consider. I would think number one might be, Professor Plum, not just longevity, but are you married? And that plays a role, correct?
Right. So we're going to start with, the first thing you're going to talk about is, how long do you expect to live? And then we bring in the idea of, okay, are you married? And if you are married, how long will your benefit last? Because your benefit may not be over when you are. Your benefit may continue on even after you die. It may continue to your surviving spouse if it's the larger of the two benefits. And so you may think, well, I'm just a normal person. I'm going to, 81, 82, 83, that's about where I'm at, give or take on my life expectancy. So that's, I'll take it early. But you're married to somebody who's 4 or 5 years younger than you and whose benefit may be less than yours, even if they waited later. And so your benefit doesn't stop at age 81. If you died at age 81, your benefit continues for your surviving spouse as long as they're alive.
Yeah.
So your benefit may continue for a long time. But it just goes into play, what is the best strategy for you? How do we make this work both financially and emotionally? Some people, they're just give me the benefit as soon. I've paid into it forever. I want to get it as soon as I can get it. I want my money back before the government defaults on me. They're not going to.
That's not going to happen.
So it's just
okay. So look. So what you've said so far is that whether you take it at age 62 or age 70, if you live to about what they expect you to live to be on the
I've run the analysis with different cost of living adjustments, different earnings rates, what you can earn on the money that you get early, playing with it back and forth, and it's in the early to mid 80s.
Okay, so if you live to be 83, 84,
it's a push.
It doesn't. Yes, if you take it at 62 or you take it at 70, you're going to wind up in general with about the same amount of money over that period of time.
If you delay, you're taking money out of your portfolio, which then you have less of a portfolio. But then once you get to 70, you're taking a lot less out of the portfolio, so the portfolio hopefully can start to recover. On the other hand, if you take it early and you're going to treat it as if, comparing against waiting, you're investing it for those number of years because that's money that you don't have to take out of the portfolio. Where do I run into my break even? And that's where we play with different rates of return.
Yeah, we're not going to get too much into that because you could take this as far as you want.
Then you can lay in, well, if I take it early and my spouse is still working, and this is a consideration, I have to pay taxes on the benefit, so I'm going to lose some of the benefit. But then once my spouse retires, most of our income is going to come from Social Security and a little bit of IRA, so I won't be paying any taxes on a lot of my Social Security. So I have not only will I have a bigger benefit, but I won't have to lose some of it to taxation. So
and then if you take it at 62, you're not paying your Medicare benefit yet. So you're going to, your Medicare premium.
Presumably at 62, your choice is, I'm retiring at 62, so I'm going to have health insurance from somewhere.
Yeah.
So I'm going to say you're going to pay the health insurance one way or another. You don't have Medicare until 65. And so the health insurance question, whether I take Social Security or don't take Social Security at 62, even though I retired at 62, I'm paying health insurance. That's just one of my expenses.
Well, you are, but just as far as your actual benefit, it's not being reduced. So that may be a consideration. I don't know. Now, so there are situations. Now, I would say you would agree with the premise that if you think you're going to, in general, if you're going to live a long time, you should probably wait. If you don't think you're going to live a long time, you should probably take it early. However,
that's your starting point. Yep.
However, yes, there are situations for a married person, a married couple, where perhaps the person who isn't going to live as long is not planning on living as long as the...
Not expecting.
Yes.
I hate the planning part.
You're right. That. Yeah. The person who is not expecting to live as long may still want to wait as long as possible. Let's talk about that for a second. Why would that be?
Well, let's take my situation. My Social Security benefit is larger than my spouse's. And even if my spouse waits until age 70, my Social Security benefit is going to be quite a bit larger than her benefit.
Yes. You've worked more, and she did I shouldn't say that.
She worked her tail off, but she didn't get paid as much taking care of the kids and thankfully raising the kids.
You did the W-2 work. Okay, got it. All right.
So whether I believe I'm going to make it to 90 or higher or 70 or higher, my benefit is the one that's going to continue for as long as either one of us is alive. And I expect her to live to be, 100. And so my benefits are going to last for a really, really, really long time. So even if I thought that my health wasn't that great and I might pass at 73, 74, 75, for the benefit of my spouse, I'm waiting until age 70 to take my Social Security benefit so that she can continue that higher number once I'm gone. Now, her benefit will go away. When the survivor benefit does come into play, you don't get your own benefit and the survivor benefit, full survivor benefit on top of each other and double up.
One.
You get the higher of the two, basically. And so
it's really how long the benefit will survive, not so much
how long the person, the owner.
Yeah, not so much the person. Correct?
Yes and no, but when it comes to what factors are we playing with here? In that situation, we were dealing with a married couple, 2 people. That's it. But what if I have kids from later in life, and I have youngsters still in the house, or I've inherited and adopted grandkids that I'm raising?
Oh man!
And so, if I take my benefit, other people will get benefits as well. Kids will get benefits, and that may help pay for some college too. So we have to look at what we're giving up. What is it that we could be getting? And there's times when a married couple may want to take it early, especially if the lower wage or was a non-working spouse who has almost no benefit, because you cannot get a spousal benefit anymore, spousal retirement benefit, until the worker starts receiving their benefit. So if my wife did not have her own Social Security benefit, she can't get a spousal benefit from my work experience until I actually start taking it. Yeah. Well, if I wait till age 70, then that means she's got 3 years that she can't get, or however many years that she can't get a benefit early. So it's not just looking at my benefit, it's looking at what would I be receiving if I started early.
Amazing how complicated this whole thing can become.
And what am I giving up by taking it later? Or
so
what am
if I
gaining
came,
by taking it
all right, so if I came to you, I don't know if you want, I'm just throwing this at you, and I said, okay, hey, Professor Plum, I'd like to know when I should start taking my benefit. I'd like to know when my spouse should start taking a benefit. Go through this with me and ask me the questions that you need to know.
Well, the first thing obviously I need to know, but date of birth for you, date of birth for your spouse. How close in age are you?
Yes. Okay, I'm going to tell you we're within 3 months of each other.
So pretty much same age. Okay.
Yeah.
What is your benefit projected to be at full retirement age? What is her benefit projected to be at full retirement age? Now we can start talking about what we're giving up, what we're gaining and doing.
All right,
we need to know that information.
Let me make up a number. I'll say at full retirement age, let's say mine is $2,700 a month.
Okay.
And hers is $1,700 a month.
Okay. So what I heard there is the spousal benefit is not an issue because she'll never receive a spousal benefit because hers is better than yours. So we don't.
Her benefit is better than my spousal.
Her benefit is better than a spousal benefit she'll get from your. Okay. So we can ignore that last thing I talked about with the spouse.
Okay, good.
Getting a benefit.
Good. So that's off the table. All right, go ahead.
How long we going to live, buddy?
Okay, let's say I believe we're both going to live about the same, and I suspect that one of us, if not both of us, will live into the late 80s.
Okay,
based on genetics.
But most likely, okay. I'm hearing some hesitation in that. So what I would plan on is deferring yours and praying that one of you lives into your late 80s.
So waiting on mine and
yours being the higher one.
Yes, it is.
But because we don't know for sure, let's play 50-50 here. Take hers early. Take hers when she can get it, because you're saying you don't think both of you will live into your late 80s.
We could. I highly suspect one of us will.
See, this is where there is no exact right answer because we just don't know the answer.
No, I'm looking for general.
Now, do you want to bet that you're going to both live mid-80s or better?
No.
Okay, then we take the higher one later, the lower one early.
So really what she could do if she's retired at age 62, she could start taking it. That would benefit her to take it as early as possible.
Potentially. Now, we go back to the little other thing. Are you going to be working from 62 to 65, 66?
I'm going to work. Let's say I'm going to work until 65.
Okay. And that might have an issue because if she takes her benefit, she will be paying Social Security, or she will be paying taxes on her benefit.
And
good
so point.
You may want to wait
based on what
because the household income is over the thresholds, subjecting. You make $4 million a year. Of course, her Social Security is going to be taxable.
$4 million. I'm out of here.
1 year. Just give me 1 year.
That's all I need. 1 year. Exactly. Okay, so there's taxes to consider in this.
Taxes are another consideration because once you retire and you're getting your Social Security, I know you've got a little bit of pensions here and there.
Yeah.
But the majority of your money, probably half of it or better, is going to be Social Security, give or take. And you probably won't be paying taxes on very much of your Social Security once you ultimately retire. This is something that we can go into further. But you have to consider the fact that if she starts receiving it at 62, you are going to lose part of it because of taxation.
Huh. Okay.
Just a thought. And some people are, very anti-tax and they don't want to pay taxes on it. Now, if when you do retire, if you're taking $100,000 a year out of your IRAs and your pensions, it's going to be taxable then anyway.
Right.
It's less of a consideration because it's always going to be taxable. But if when you ultimately retire, if you're pulling a household income of 80 and 50 of it's coming from Social Security or 60 of it's coming from Social Security, then almost none of the Social Security will be taxed, or not a lot of the Social Security will be taxable, a lot less taxes. It pays to wait a little while longer, maybe age 65 to get it.
You mean for my wife to wait in this case?
Well, yeah, for your wife to wait in this case.
How long do you think I should wait based on these numbers that I gave you?
Based on the fact that you expect at least one of you to live a long time, I'd say you wait till 70.
Wait till 70.
Yeah. Now, if you and from a planning perspective, if we're setting up your buckets, if we're setting up the strategy, if we're waiting until age 70 to start your benefit, that means we're putting more money into bucket number one. We're being a little more conservative on the overall portfolio because we're going to rely on the portfolio for a little bit more money from 65 to 70 than we would have if we had taken your Social Security. And it's very easy to change your mind from 65 to 70 and say, no, I'm going to take my Social Security now and rely less on my portfolio. Well, that makes it easy to move. You can move from a safer, a conservative portfolio to a more aggressive portfolio.
You can't always,
regardless of what the market conditions are.
Of course.
But if you plan on taking it at 65, which means that you have less money in the safer areas, you're going to be a little more aggressive because you don't need the portfolio for as much. But then you change your mind and you say, no, I'm going to wait till 70. Now we have to look at, okay, what's the market doing right now? Now is a good time to reposition assets from a more aggressive 3 to bucket number 1. Maybe we're in the middle of a 2008 downturn.
May not be a good time.
Right. Yeah. But unfortunately, that's when people want to make that decision. Say, I can't count on my portfolio. I've got it.
Now, okay, let's say that we have some good pensions at age 65.
Okay.
Especially, let's say my wife's is very good, better than my little meager.
Right. You do have pensions.
Right. We have pensions, but hers is quite good. Where does that play a role?
Well, it comes into that taxation number that I talked about before, but it also just comes into how much are you going to spend? I mean, good pensions are nice, but if you've got really high spending, that's just part of the game.
Yeah, hopefully it wouldn't be too much. I don't know. Again, I'm making these numbers up, so I don't. I have to. I can't keep track of exactly what I'm telling you.
But we do have to make a decision on pensions. We have to make a decision on the survivor option on those pensions.
So in my case,
in determining your Social Security and playing the options of Social Security, determining your pension options, the survivor options and things, those we talk about first, and we make those assumptions and make those expected movements first, and then we layer in what the portfolio has to do on top of that.
Yeah, because
how do I know how to invest my portfolio if I don't know how much I'm actually going to have to draw out of my portfolio at a given period of time?
Yeah, what you're saying is that Social Security will provide an income, but whatever Social Security doesn't provide,
and your pensions don't
and
provide,
my pensions don't provide,
got to come from the portfolio.
Yeah, and so the less that I get from Social Security or pension, the more stress or strain is,
the more distribution is going to happen from the portfolio.
Yeah, and you have to plan for that,
and we have to account for that. We have to put the strategy in place to be able to provide for that. So that if the markets do what they have done in the past, what they're going to do, what they've done in the past, we just don't know when. If we have another downturn.
Yeah, and that's, of course, a big part of this. So what you've determined from my little tableau here is that I should probably, my wife in this example that I gave you, should take it early, but understand that there may be some taxes involved on hers.
Yeah. And so she may want to wait until you're retired, because that way you don't have to pay tax on it, and the benefit will be a little larger.
But if we do wait, then we'll have to understand that since she is retired, let's say at age 62, that we may need another source of bucket one income.
Do we need bucket? If you're working and she's got, she wouldn't have her pension yet. You said they start at 65.
Yeah.
If you're working, do you need to pull more money?
And that's a consideration.
Now it's a matter of, okay, where are we going to get the money from? Are we going to get it from Social Security? Are we going to get it from your investments? Are you an aggressive investor, or are you a very conservative investor?
Are you a good witch or a bad witch? Yes. Well, you see this now.
Invest it. Safe.
Witch angel and the devil on the shoulder. Okay, so this is why we're having this discussion today, because if you go online and I did this and I say, when's the best age to take Social Security, they'll kind of say it depends, but they'll say, really, they just kind of say, how long are you going to live? You're going to live a long time, take it later.
It's a factor, yeah.
But it's not the overriding factor.
I think it's probably the more important of the factors we've discussed. But
it's not a hard and fast rule.
No, it's not a hard and fast rule.
Let's put it that way.
There are, I can't, other than if you're age 70 and a half or older and making charitable contributions somewhere, doing a QCD, I can't think of any hard and fast rules out there that apply across the board to everybody.
Yeah, of course.
So everything it depends.
But I see that,
with the exception of QCDs.
But I see that so much when I do a simple search online.
Well, that's because they have only so much space and they can't go through, and it gets really confusing. You're going to lose readers if you talk about it depends.
Have we lost listeners because we've talked about this today? I hope not. That's the one thing I can't find out is who's tuned out.
Well, let's see. You saw what the numbers were last week.
I can judge it now. Yeah. I can judge it next week.
Let's check 2 weeks.
This is an important consideration, and I like to bring it up because Social Security is the foundation for the rest of your portfolio. I mean, guaranteed income, which this is.
Guaranteed income is very important.
Social Security and pensions, but especially because more people have Social Security than have pensions.
But they kind of play the same game. You have to whether it's Social Security, know when to take it. Pensions, know when to take it, because depending upon how old you are, your pension may be reduced quite a bit. Like say if you're 58 and the normal retirement age for your pension was 65, you want to take it at 58.
Well,
it's a lot lower than you would
course.
get at 65. So when is the right time to take your pension? What is the right option? Unlike Social Security, where there's no reduction in your Social Security to provide for a spousal benefit or a survivor benefit in the
there
future,
is for a pension.
With a pension, it's definitely actuarially.
Can you really go wrong though? Ultimately, I mean, people can stew about this question, and I don't want to get it wrong. You can get a pension decision wrong, I think. But I mean, as far as Social Security, if you take it at 62, and you should have waited because that's what the numbers kind of tell you.
Well, by the time you're 83, 84, you've got your budget fairly well worked out.
Haven't you adjusted?
You've probably adjusted pretty well. And it's, you're probably not going to think to yourself, man, I'm 84 and I made it this far, 85. I'm 80. Oh, man, I really should have waited to take my Social Security. You're probably not going to beat yourself up too much.
No, you're not going to do that. Because even at age 83, 84, 85, the difference is not that much at that point.
No, at that point, at 95, the financially, your heirs would have been a lot better off if you had waited. But are you going to really care at that point?
Yeah, I don't know. It's
the other way to look at it is if you defer, you're a single person and you think you're going to live a long time, so you defer until age 70. Only two things are going to happen. One of two things. Either you're going to live long enough to be happy about your decision,
or you're not going to care.
Or you're not going to live long enough to care. So it comes more into play when you have options like the spousal survivor benefit and things of that nature.
I say this, Professor Plum, because so many times, again, when you look online, they say, why would you ever take it early? It's a huge mistake to take it early. Look at the bigger checks you're getting. I mean, by the time you're 70. And I mean, I know there are reasons not to take it early, but honestly, I just don't see it being...
Well, one of the reasons not to take it early is you're still working and making more than the threshold.
Well, then you can't... Obviously,
you have a retirement earnings test.
Of course.
One of the big confusions in Social Security is people confuse the retirement earnings test and the taxation test.
Yeah.
No, not test. The taxation.
The taxation of it, yeah.
The taxation of a benefit that you're receiving, that you're eligible for and receive, is its own world. The retirement earnings test, or the earnings test is what they call it, that just tells you that you're not even eligible for the benefit, and if they paid it to you, they want it back.
Well, that's why
and that only applies if you're under full retirement age.
Well, and I'm assuming in this case, when I say take the benefit, that you are eligible to do so.
Right.
And there's no reduction in it. Somebody who just can't take it.
Yeah, and so somebody who, maybe they retire at 62 and they're thinking about taking their Social Security, but they're retired from a position that they really wanted to get away from. It wasn't that they hate working; they hated the position they were in.
Mm-hmm.
And maybe if they think that they're going to, be retired for 6-8 months, but then go back to work, that's a reason to wait, because you don't want to have to deal with trying to get Social Security, paying it back, and doing all the other things.
Well,
so for somebody who's retiring at 62, unless they are sure they're never going to go back to work, okay, then if you can make the decision to take. But if you think you might go back to work somewhere else, even a different place,
well, can't you suspend it though? I mean,
it's
stop
difficult.
it.
It's difficult to suspend it under full retirement age.
Mm.
If you go in, because you got to go tell Social Security.
You got to tell them
first
what's
off, you got to
happening.
get an appointment with Social Security, which isn't going to happen tomorrow. And you got to, and they want to know that you're actually going to stay with the job, because you're not supposed to suspend it. But anyway,
doesn't matter.
Once you show them that you're working, and you show them, they may suspend it at that point.
All right, but
so that you don't have to pay them back even more than what you already owe them.
I tell you what, with all the complicated things that we've talked about today, the decisions that we make, it's not.
Yeah, but 10 years ago, they made our life so much simpler by taking away a lot of our options.
Well, they did. And so it is a little bit simpler now than it used to be. We have fewer options. But I think for people who are just still saying, I still don't know whether I should take it early or not, I think I'm safe in saying that take it when you think you need it. Take it when you want to take it, and don't worry about it.
Call an advisor that knows the system, and
even better,
will help you build your strategy around the more what seems to be the most efficient use of money for you.
Yeah, let somebody else handle it. Do you know anybody who can handle these kinds of decisions, Professor Plum?
I got a few people I could call.
I got one you can call right now, Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. I glanced to my left. I'm just kidding.
At your little cheat sheet.
Yeah, that's right. And Lucia Capital Group, you do this all the time. I mean, this part of the it's such a big part of the financial plan that you can't ignore it.
This is the foundation of your financial retirement. You got to get it spelled out. You need this done before you can figure out how to invest your money.
800-644-1150, the number at Lucia Capital Group. 800-644-1150. Go online, of course, luciacap.com, LUCIACAP.com. Find more articles, and we've got videos and blog posts and all that other great stuff there. And don't forget, we've also got a Social Security decision kit. I think we updated it for 2024, but now I'm not so sure. And we're this far into the year, Professor Plum. All right. Look at it anyway, okay? A couple of numbers may be from last year, but it's not that big a difference. What it's going to give you is the ideas.
The concept is there.
Right, the ideas that you need to know. Go to luciacap.com, type in Social Security in the search bar, and you'll see that come up. Social Security Guide, free to download for you. Also, you got the retirement guide. Well, you have the estate planning guide.
Yep.
And you got the bucket strategy guide. So type in bucket strategy, and you'll find it right there at luciacap.com. Don't forget to subscribe to this podcast. I want to keep reminding you of that. Why? Because, this is the last episode of the season.
Is it? Or I thought we had one more.
No. This is it. I checked right beforehand. Adam told me. Adam Clark, who's one of our behind-the-scenes
production
people.
Wizards.
Yes, that doesn't get enough credit, by the way. In fact, he rarely gets credit. I should mention the people behind the scenes that do this. But Adam is one. I said, this is it for the season. Correct, because we got to time it for the end of the year. So you'll have a couple of repeat episodes coming up, and then we'll be back in full swing.
Next season for the
That's
end
right.
of the year.
That's right. As fall gets underway, or is underway, subscribe Apple Podcasts or Spotify. Either one. Make sure that you add to those numbers because we like watching them go up. All right? Do that, and you will not miss a single episode. Thank you, Professor Plum. I know you got a meeting.
Yes, I do.
All right, you get to that. I'll get to the rest of this stuff. For Professor Rick Plum, certified financial planner professional, I'm your podcast host, Johnny Dean. Thanks for listening. Talk to you again next time.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, a member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.